What do investors look for? This is important to understand. They look for to understand the health of your business. What they want to understand are primarily these 6 things. They want to see if that problem statement which you have defined, is it well defined? Are you actually understanding the problem, or is it just a copy of somebody else's business idea, or taken from an academic perspective? Like we take from economic surveys, we take from financial reports that here is a gap, here is the sector where, like we take agriculture, we say there is scope of horticulture in respect of Kashmir region. I'll tell you one important figure, which is about apple orchards. We have a production of 21 lakh ton here annually. We have CA stores which can address to only 3 lakh tons of apples. Means there's a gap of 18 lakh tons of apples which can be stored in CA stores if we want to. We do not want to sell the entire lot of production in one go. Even if only 50% of it is kept aside for CA stores, we still have a gap of 9 lakh tons. But then this is all academic. A startup will not go there to find out that these are the actual figures. If we go by this figure, this could be a misleading figure, because actually a story is little bit different. There are 3 lakh, I said the capacity is 3 lakh tons, but there are many more have come up. But the existing ones are not also able to cater to the entire capacity that they have created, which actually means that it's not even 3 lakh, it's about 2 lakh tons which is being stored in CA stores. So actual figure is slightly different than the academic figure that is coming up. So this is just for an example that when we define a problem statement, we should not entirely rely upon some kind of figure that is going around, that's taking rounds in the market. Then the second point that investors look at is the disruptive nature of your solution, or its technology-based and scalable capacity. So it has to have 3 things, and you must demonstrate that it has 3 things embedded in the solution that you are proposing. Does your startup show signs of growth? He is very much interested in seeing whether you are showing signs of growth. How would he actually measure it? He would measure it from your financials. He would measure from your explanation that you are giving about your financial projections and the basis of your financial projects. How do you base your financial projects? How do you say that your growth will be if your revenues for the current year have been, let us say, 10 lakhs, and you are projecting for the next year, you are projecting at 25 lakhs. What is the basis of saying that you will grow at 150%? So you must have some explanation about projections that you make. If those are correct and those are based on certain fundamentals, then the signs of growth are strong. Is addressable market size well defined? Again, the same question as I have just explained in terms of CA stores. Addressable market has to be well defined. If you want to create a CA store may be at the most cater to about 40 to 50,000 tons for the whole year. So if you are looking at the gap of 9 lakh crores, you are not actually addressing the entire 9 lakh tons. You are addressing at the most about 40 to 50,000 tons only. So that is the gap. That is the addressable market size that you are actually looking at. Then the 5th thing is about that, what I just discussed is about the capability and passion of the founders and the team. Investors look at this. That is one indicator of the health of your business. And if your minimum viable product has been launched, is there any visible traction? The investor would definitely like to understand that traction if that has happened. So if you have already crossed the launch of your MVP, he will try to see if there is proper response, sufficient response, customer response. If people are coming back to buy the same product that you have launched, if that retention is there, that's one important indicator of the visible traction that he wants to see. Now look at this. When they are in the first instance satisfied or convinced about your pitch deck, and they are in the next phase of their thinking that they will go for the investments, they go for this due diligence. This is another toolkit that you need to keep ready. This is not separate from the first toolkit, but these are the components of the same thing. They start with the legal status. I will give you many examples of Srinagar. There are so many cases that come up before us, and then they seek funding because they have found out that there's an angel network created, and we don't go to bank, we go to the angel network for funding. They come up with their ideas. Then in the midway, this has happened in at least in a couple of cases. Then in the midway, I asked them, what's your status, legal status? They say, we have proprietorship. Another one says, I'm a firm. So I said, this doesn't go well with the angel finance. How are you coming up with this idea that you will get somebody to finance you when you are just a proprietorship firm? So this legal status is the first thing that investors see, and see whether this is in an incorporated private limited company where equity could be shared. So in many startups don't know, at least in our ecosystem. This is a tier 2 city. We'll talk about tier 2 city, tier 3 cities also later in the slides. If in our kind of an ecosystem, which is yet in its budding stage, I tell you clearly that we are far behind other ecosystems, other states in the knowledge base and understanding of the ecosystem and how it works. We are currently in the process of conducting seminars, meetings, conventions, and telling people that angel finance works this way. So that's our fundamental work, and we have tied up with NIT, National Institute of Technology, Srinagar. We did recently a technical evaluation with Deputy Commissioner Gandarbal, and were at least 12. When most of those who were doing good were from SCOST, Agriculture University of Kashmir. They topped in the list, and they were awarded yesterday by the LG of J&K. We found that just one or two institutions are there which have the proper ecosystem, and that too till the ideation stage only. They also don't know the go-to-market strategy. They take them to the stage where their products or technologies are validated. From there onwards, they tell them, now it's your field, your market, it's your baby. Go and nourish it. But the founders, they don't have any support system beyond this Kashmir Angel Network. Now there's an EDI, but that EDI is also not, people are not satisfied with working, and they also are short of funds. I don't know what happens there, but that's beyond the discussion. So what I'm trying to tell you, this legal system and the shortcomings is a direct result of the lack of knowledge and the ecosystem that is yet to be mature enough to tell them what they need to create for having funds. Then due diligence also involves business model, checking of business model. It involves checking of financial statements, all financial statements that go into the income tax department, like balance sheet, the schedules connected to it, and profit and loss accounts, cash flow statements. All this is actually a process of due diligence where investors deeply dive into it. Then they also find out if there are existing loans. Certain people, I have experience of this kind of thing also. People come to us seeking funds from investors, and then saying, we need, our primary goal of applying these funds is to repay the loans to bank. Now no investor is ready to pay somebody so that he can repay to the bank. This is not about growth. This is not about scaling up the business. This is about just setting off previous mistakes, because he cannot repay the loan from its business operations. He wants funds to come from the investors to scare off the loans. This is one factor which needs to be understood, that due diligence will definitely call for finding out whether you are in debt of loan and you are not in a position to repay it, and you only want to have investors repay it for you. And then another due diligence could be revenue. They will find out the growth path of revenue. If you are actually earning it, and then there's a path upwards, there's a growth mark with revenue, and then if they see so, then that's one attractive feature for the investor. Last year's growth rate is also one factor which they see. If there's no growth in the previous year, they will definitely see if there are any red flags attached to the startup. There could be certain things, there could be some mishappening, there could be some sales issues, there could be some marketing issues where growth has not taken place or it has declined during the last year. It is also a red flag for them. Then they will see the margins of profits, they will see the margins of gross profits, net profits, and then we'll talk about EBITDA in a while. The margins are important for them to understand if they are in positive, and if positive, if they are growing. Then debt to equity ratio. We could have a dual model, a mixed model, where people are, the startups, any business actually, could be having debt finance and also trying to have the equity finance. The mixed model also works well. But then it has to be clearly understood that if you are taking a debt from a bank or an institution, you will have to scare it off from the operations that you're conducting, from the revenue that you're earning, without touching the part where you have taken funds from investors. Because if you mix it up, then you are actually misappropriating the funds that investor has given to you. He has given to you for scaling up. He has not given it to you for scaring off something which you could not do it from your revenue, which is a negative factor of your business. Then there is EBITDA. EBITDA means earnings before interest, depreciation, taxation, and amortization. It's also called, in technical terms, you could also call it the book profit. It's a sort of a thing called book profit. And after book profit, these things are removed, and then net part which is the taxable income or net profit. But that is not what is attracting the customer, the investor. It attracts the investor when he or she understands the figure before these are deducted from the net profit. So this is one very important factor for investors to understand, whether EBITDA is positive, it's healthy. If it is healthy, then we will go ahead. And then we also has to see compound annual growth rate. It applies to certain startups which are only 2 or 3 years in business, and there's a revenue, and their growth can be measured for the last couple of years or 3 years, and the average is taken after that growth is actually compound annual growth rate. If that is positive, and normally in business parlance we say at least 20-25% growth rate in CAGR is said to be healthy growth. If that is there, then the investor is interested. Finally, if he is satisfied, convinced to all the marks that we have just discussed, then he finally comes up with the binding agreement. Then binding agreement is decided. That's also part of the due diligence. At this stage, funding starts.